Good morning, everyone, and welcome to the final part of VAT for Dummies, filing and compliance. My name is Matthew Harrison. I am one of the sales delivery consultants here at Avalara. A number of us here wrote the VAT for Dummies book. It took us a while, but it's a great book and it's got some great information in there. So if you haven't taken the time to go and have a look, then also go and have a look at this book. It gives you a quick cheat on the very different aspects around compliance and the treatment in the EU for different goods and services. Okay, so let's progress forward. Okay, what we're going to cover today. So we're going to cover 4 different aspects. What is filing and compliance? We're just going to give a quick brief overview. We're then going to drill down into the different types of returns and the different kind of nuances between them. We're just going to briefly discuss payments and refunds, invoicing and exchange rates. And then finally we're going to end with penalties and non-compliance and just kind of the complexities and the issues around that area. So right, what is filing and compliance? Now, many of you would ask, well, I want a VAT number, but what comes along with that VAT number? And what you need to know is that every time you register in a country, you're then required to comply with that local legislation. So in every instance, if you are filing, if you filed a registration in a country, you then have an obligation to file returns in that country. Now, the key thing to understand is you don't dictate when you file. The tax office dictates when you file. So they have different frequencies of filing. Those frequencies are dependent on a number of different things. Some countries only have 1, maybe 2 frequencies. Some countries it's based on your VAT payable for the year. Some it's based on turnover. And some it's based on your activity. So for different activities, you might be filing different frequency returns. And again, there's some tax offices in the EU. They will originally put you on monthly returns because they want to check your tax activity, and then if you've got below a certain threshold, they sometimes put you down onto a lower frequency of returns. It's also important to understand that alongside the monthly, bi-monthly, quarterly, biannual returns, there is sometimes an additional annual in each country. So, for example, you've got Germany. They have either quarterly or monthly returns. But at the end of the year, there's an annual reconciliation return, and you have to file that by a certain period after the year is finished. It just has all the information from the previous period you filed. And drilling down into those returns, the number of boxes can vary massively on these tax returns. So there may be some tax returns, like the UK and Ireland, that you find, they're quite easy. We can fill those out. But as you go into other countries where the number of boxes start being in the hundreds, you start thinking, right, okay, I need to make sure I'm actually doing these compliantly because there's a number of boxes that may need to be completed, and I don't want to fill out the wrong box to give myself the wrong VAT liability. Because that's the main issue. If you fill out the wrong box and you overstate or understate your VAT liability, it can cause you problems. It can cause you problems in both areas, whether it be audit, whether it be penalties. It will always cause you those problems. Now, a number of countries are kind of trying to implement more multilingual stuff, but on the whole, most local returns are in the local language, which means that you either have to have someone that's kind of speaking the local language, or at least understands kind of what goes in what box and understands it more in more detail. Now, our VAT reporting system that we use, we can produce returns in English and local language. So it's a fantastic bit of software that we've got there. Now, as far as supplementary filings are concerned, a lot of people don't understand about supplementary filings. These are often upon the client to understand when these need to be filed, because there are instances where they do need to be filed, and there are instances where that they don't need to be filed. You might have to hit a threshold, or it might be specific to a certain type of transaction. Now, these again, some of them you're prompted by the tax office, and some of them the tax office will not prompt you. So please be careful with those. Now, the different filing requirements. Now, within the EU, you have varying different formats of e-filing. So it could be that you have to upload the file, you might have to key in some information, or as you'll see here, we've listed Malta. So Malta is still very, very manual in their approach. You have to hand the VAT return to the tax office. We believe this is likely to be changed in the near future, because this is kind of not a sustainable activity as the way these kind of progressing, with the more companies being registered everywhere. So we would probably see a lot of shift away from the manual tax returns. So now we've got the e-filing transactions. So it's kind of e-invoice filing transactions and the currencies. I'm not going to go too much into detail in these, because we're going to talk about some of this later on in the presentation. But if I just drill down deeper, because it was just a general overview there. So now we're going to go on to different returns and how they're submitted. So we're just going to go through a brief overview first before we dive down into the different returns. So many people ask, what is an effective date? Like when do I know when I need to file from? Well, when you submit an application to the tax office, in most countries, and this is not all, because there are some countries where you can't choose your effective date. The tax office choose your effective date for you. So that effective date can be chosen by you. So it would be information that you would enter on the application form when filing those registrations, and you would choose it based on a number of things. So if you're distance selling, you would choose the point when you cross that threshold. If you're doing an event, then it might be when you started selling tickets. So you do have a choice of choosing that threshold, but please be aware that if you are going to choose a date in the past, there is going to be possible kind of registration penalties that you might suffer. So and you also those returns that you file. Those returns that you file will be due immediately upon that registration. So the tax office will give you a date. Most tax offices will give you a date. They want all the overdue returns to be filed by this date, and then they would expect payment as well very shortly after that. And how can I file my returns? So there's a couple of different formats, but if you're required to submit electronic returns, what you have to do is, alongside the registration, there's an additional form that you would be filing for your kind of e-certificate, they call it, or your electronic signature. So this gives you kind of access to the portal to be able to file. So the company signatory would have to be the authorised person, so it would have to be someone that is eligible to sign documents on behalf of the company. So they would have to apply for the electronic signature. And then you can file those returns with the tax offices. Now, there's many different, like I've said in the previous slide, there's many different kind of formats of how these are filed, and you'll see as you progress into the EU, all the different formats, the different ways you file those returns, the different looks and how they will look online, because that's another thing. As you imagine, with 28 different EU member states, 28 about 20 different languages. Those can get complex. People decide to put things different ways on different returns. That means that what you might have of output and input on one return might be completely different on another return. They generally follow a similar format, but things like reverse charge transactions can be reported differently in one country to another on tax returns. So it's important to know what boxes you're definitely using for those different transactions if you have a large amount of different transactions within the country. But like I've put here in the slide, tax offices are looking to eradicate paper returns. Now, there may be some of you filing on paper returns. The tax office may approach you saying, look, you need to file your e-signature. I know that there was a few years ago, Romania approached everyone that was filing paper returns to say, look, you need to apply for an e-signature by this date. So these are things that we're going to see happening. I imagine it won't be too long before paper returns becomes no more, at least for the non-residents filing from other countries. And the last thing is, when do I file? So the tax office sets a clear calendar every year on when they would expect returns to be filed. Now, what you need to understand as well is that each tax office works differently. So some tax offices will say if the deadline falls on a weekend, it's the Monday. But some tax offices will say if the deadline falls on the weekend, it's the Friday. So you have to be clear on when these are required to be filed and make sure you're sticking to those calendars. So it's definitely a good idea to look and have those calendars available to you, because without those, it's hard to be compliant. It's hard to understand when you need to file, when you can prep that data. If you get to a point where you are filing, then what you need to do is you just need to file those returns with the tax office, obviously through your electronic signature, and you generally get kind of a submission notice back to say, look, you filed. Well, we've received your file, and that kind of is your confirmation from the tax office to say, yeah, my tax return has been filed. And that's the difference between filing electronically and filing paper. You don't get that in paper. You don't know your tax return has been received until you maybe call the tax office days after the filing deadline, or you find out maybe from the tax office that it hasn't been received, and that's the difference. It's always better if you have if you have the ability to be able to file electronically, then it's definitely a good option for you. Okay, so we've talked about kind of what's the effect, what is an effective date, how can you file your returns, and when do you file your returns. But let's go more into the different types. So different activity will dictate often what returns you need to file in each country. So those different returns can be kind of filed on different dates in different countries. So you might be filing your VAT return on a monthly basis. You might be filing quarterly EC sales lists, or it's more common for the EC sales lists and VAT returns to follow the VAT return filing frequency. So whether it be, if the VAT returns are monthly, then it might be your EC sales lists are monthly. But again, there might be different dates, so that's something you need to consider. So it might be that you have to file your EC sales list by the 15th, but the VAT return by the 25th. So it's really important to understand when those filing dates are. So what will always happen, what you can always be guaranteed, is that when you're filing that registration, you need to file those VAT returns. So VAT returns are the one thing that you always definitely need to file. I mean, there's a few instances where countries have special arrangements where you only file when you have activity, like in France, but on the whole, if you are VAT registered, you need to start filing from that effective date that's given by the tax office. So VAT returns. Pretty simple. They cover all your transactions that happen in that country, and for some countries, they also include the transactions that happen outside that country. So it is important to understand that you're actually completing those VAT returns correctly, and you're including all the relevant information that you should be. Now, EC sales lists. You may get prompted by a tax office, but often, if you're getting prompted, you're probably filing them too late. So, EC sales and purchase listings. So, there are a number of countries across the EU that require EC sales and purchase listings to be filed. So that's your intra-community acquisitions and sales to be filed on those listings. There are some countries, though, or I would say the majority of the countries, only require you to file EC sales. So what that means is, if you make acquisitions, if you make a purchase from one EU country into the country you're registered, you might not necessarily need to file that EC sales list. So you would need to look again to the local legislation to understand: do I need to file it in this country, or do I need to file it in another country to understand? So, for example, Spain, they have a purchase list, an EC sales and purchase listing. So if you move stock into Spain, you'll then be required to file that listing. Whereas if you're talking about Germany, if you move stock into Germany, you don't have to file that listing because they only have it on EC sales. So just to kind of understand the difference in the different countries across the EU. Now, Intrastat. So Intrastat is kind of coupled with thresholds. And again, this is another return where a tax office, if they're contacting you about it, it's likely you're filing it too late. So it is something you need to monitor. And on this instance as well, you need to monitor both arrivals and dispatches. So to explain what arrivals are and dispatches, it's kind of the same as EC sales and EC purchase. So arrivals is considered to be effectively an intra-community acquisition, and a dispatch is considered to be an intra-community sale. And once you hit one of those thresholds, you have to file for both. So that's the key importance. And again, some countries have really strange thresholds for this. So, like France and Spain, you need to be careful because they have kind of these strange thresholds. They might not have it on purchases. I know that Italy this year released the Intrastat having to be filed for goods coming into Italy, but there's a zero threshold for goods going out of Italy for filing Intrastat. So it's just one of those things you need to understand the local legislation. Now, control statements and reverse charge listings. So these are kind of tax office trying to drill down deeper into your transactions and understand, are you charging correctly? Are you applying the right kind of tax treatment to your transactions? And then once they've got those kind of that kind of information, they can pair that up with other companies, understand, is everyone declaring correctly? And it just gives the tax office kind of a clearer picture on whether you are reporting correctly and whether there's any kind of anything they need to maybe potentially audit, or they need to look down into more detail. Now, the reverse charge listings, they're mainly around the high risk products, and they're not as common maybe as the control statements, but they are very, very important because they do cover these products that are high risk, and they're considered to be kind of hot on what the tax office want to follow. So it's key to file both of those returns, and a lot of these returns. So Intrastat has a threshold, but control statements, reverse charge listings, they all need to be filed from like the first transaction. So it's something really, really clear that you need to understand. Now, finally, we're just going to talk about SAFT and real-time reporting. So SAFT and real-time reporting are kind of the way we see the future of VAT reporting. Tax officers want to drill down deeper into people's transactions and understand more, and be able to kind of almost audit on an ongoing basis, do a mini audit effectively, just to try and understand the transactions, and try and make sure that everyone's declaring everything correctly and that everyone is declaring everything, because that's the issue they have. with such a large VAT gap in the EU, it's something that they really need to kind of cover. So SAFT can be in many different formats. Some countries request it to be only to be filed upon request. Some request it to be filed on a monthly basis. So Poland's introduced that this year. So they will need to be filed every month. But again, if it's something that's very key, and using software in these elements is almost key. If you're trying to do this on a monthly basis without some sort of software involved, it can become very difficult. So it's very key to kind of cover this sort of stuff. And real-time reporting is even harder. Trying to do real-time reporting without an element of software can be incredibly time-consuming and difficult. So that's where we see the vision of the EU going. So software is key for the future. And the real-time reporting, just to give you a few examples, there's countries that are wanting transactions on a daily basis. I mean, Spain was one of the ones that introduced this last year. They had transactions to be submitted at least every 4 days. And Hungary and Italy are looking to implement kind of similar kind of conditions around reporting. And this is mainly focused at higher revenue companies, but it's still incredibly important. So here we go. Next is just the invoicing, payments and refunds. So to understand invoicing, now these people always ask, is it really important to have this information on? Yes, it is important to have all this information on. If a tax office sets a minimum requirement for invoices, then that's what they want to see on invoices. And it doesn't mean that they might not let it slide if they see you, if they do an audit and and you're not invoicing correctly, they might give you a small penalty or they might give you a first warning. But if you want to stay fully compliant, you want to stay ahead of the tax office, you would stick to these minimum conditions. So, I mean, current date and effective date. So, just to explain that, it might be that your effective date differs from your current date. So, it'd be important to list those two different dates. So, it might be that you deliver the goods at a different day, or you take payment on a different date, or you issue a credit note and the effective date is different. So it's what you need to understand is that there is potential for having two dates on those invoices. So you've next got the name, address, and VAT number of supplier. So this is key information. This is something you always need to have on every invoice. So most of you probably already do. It's more the customer side that people generally miss. So again, if you're just invoicing normal private individuals, they're not going to have a VAT number. So that's why I've added it saying potentially VAT number. So if you're invoicing businesses and it's an inter-community transaction, it's incredibly important to have that VAT number on there, and it is a valid VAT number, because otherwise the tax office can potentially come back to you and ask you for that VAT that you haven't charged. So a unique invoice number. So people ask, what is a unique invoice number? So what a lot of people don't understand is that some countries require sequential invoicing. So for their country. So it might be that, like, say Hungary will say, I don't want to have gaps in your invoices. I want you to invoice in Hungary with numbers one after each other. I don't want to see breaks in the numbers, and we're seeing it as being more of a common thing. So a lot of companies to get over this, they will use maybe the country codes as a starting prefix, or they might use a select number. Set of numbers for a particular country, but it is key that it is one of the factors. And again, the tax office are probably not give you severe penalties, but it is something that if they tell you that you're doing it wrong and then they ask you to change and you don't, that's when the penalties will probably likely increase. Again, a description of the goods and services. This is kind of would always be on an invoice, but it's always important to make sure it's understood that there's a deeper description on what's actually provided, because the tax office will ask more questions if there's not enough information. Next is the rate applied to a transaction. So What it's key to understand is that you do need to apply the correct rate, and this needs to be advertised. This needs to be shown, on the invoice. And this rate, you can't change the rates from one. You can't include two rates from two different countries on the same invoice. Unfortunately, you have to split those transactions. So it's clear to understand that it's an invoice per country. You can include different rates on the same invoice from the same country, but not from two separate countries. The net and gross value, the net VAT due, and the gross value. These are kind of things that would be standard for most people. They would understand that they need to show the VAT on that invoice, whether it be nil or whether it be a standard rate. That needs to be shown on the invoice so that people really understand. People understand what they're paying. The tax office understand, and also, again, the next point down follows on from kind of if you do not charge VAT. So it's important to understand if you do not charge VAT, you are required to list the reason why. So you're required to list the articles on why you haven't charged VAT. If you don't, the tax office can potentially come back to you and ask you for that VAT because you haven't provided them with a sufficient invoice to be able to understand of the reason why you haven't charged that VAT. And the last point is if a local currency is not charged on the invoice, it's important to have a valid exchange rate, and often you also need to report list the VAT amount in the country where the invoice is taking place. So that's something that's key to understand. It's not just that you can invoice in any currency. You need to be aware that these are things that are really, really important. Like, if they can't do this, they can't understand what the actual VAT value is, and they'll never be able to track back an audit and really reconcile the numbers. Because especially if you use the wrong exchange rate, they'll struggle to understand where you've got the exchange rate from. And it's important to understand that each country sets requirements around exchange rates. Now, most countries say that you can use the ECB rate, and some also say you can use the national bank of that country. So it's important to understand that the way these exchange rates are used. Some also require you to have a daily exchange rate, but some require you can use a monthly exchange rate. So it's really, really important to understand what exchange rates apply in what countries. So just to go payments and refunds. So this is a bit no one likes to make. No one likes to make payments to the tax office, but it's obviously one of the most important things. You need to understand your requirements around making these payments. So it's not just a case of making a payment, because as you can imagine, the amount of payments the tax office receives, you have to be very, very clear and specific on the information that you provide on that payment, because that can really, really affect whether it gets allocated against your account or someone else's account. And believe me, I've worked on a number of cases where we've had to a client may have paid the VAT into with an incorrect reference, or they've left the number off, and it either gets put in a special kind of side pot where they can't allocate it, or it might even get allocated against someone else's account. And this is the difficult thing. If that happens, it can be incredibly hard to get it back. And what the tax office may ask you to do is they may ask you to repay the account. So then you will end up paying it twice. So it's really key to understand that those references that are provided, if you use an agent, they'll give you a payment memo. And those references are really, really key to adhere to, because otherwise it can cause you problems in the future. And it might not be you find out in 1 month, 2 months, 3 months, but what could potentially happen is you can potentially accumulate penalties. And the tax office may not always refund those penalties, even if you have paid on time, because they'll say, well, you haven't paid the correct account on time. So tax offices can be tough sometimes. So please be aware of those payments. Now, types of payment. Now, the most common one would be a wire transfer, and this can often be made from a bank account of from another country, and that's absolutely fine. There are only a few. Spain require a Spanish bank account, a local bank account to pay the tax authorities. So it's clear to understand that you do need to look at these requirements, because what you might try and do is make a payment, gets rejected, you miss the payment deadline, and then you've got a penalty. So it's really, really key to understand what the payment conditions are in the country you're looking to register in or are registered. And the one that's being introduced, or we think is going to be introduced more heavily across Europe, is direct debits. So France currently will, after you file the return, they will pull a direct debit from your bank account, and it has to have special conditions as well. So that's key to understand. It can't just be any bank account. You need to have those special conditions be met before it can be paid. Now, I see this is probably the way it's going to go in the future, but I see it being a long time before we switch over to that method, I believe. It's taken France a long time to kind of organise this, and hopefully all the other EU nations will be able to learn from their mistakes. Refunds. Again, the same sort of rules regarding payments. You have to make sure that you understand the procedures and the way it works. Now, they say that, again, they're happy to refund to your bank account, your local bank account in some instances, but in countries like Poland, you have to have a local Polish bank account to be able to have that VAT paid back. So again, this can cause complications. If you don't know the rules, you can apply for your refund and get accepted, and then get to a point where you have to then open a bank account, which might take you a few months before you be able to actually receive that money back. So it's really clear to understand the conditions in each country before actually applying and sourcing that refund. Wire transfer. The wire transfer. So they'll do wire transfers in most instances for this money. And the one thing I would say is the HMRC do have issued checks, but I believe they are moving away from this process. So it is most common that they will send you the money back directly into your bank account. Okay, and finally, for the last one, but one of the most important things regarding tax compliance, complying and failing to comply with the tax office's requirements. So there's three main areas where we see penalties applied. So it's the late registration, it's the late filing of returns or additional returns, and it's a late payment and interest. The late payment and the interest around that late payment. So late registration penalties, they're common in some countries, but most tax offices across the EU, they prefer the other two penalties. They're kind of more the penalties that the companies get given. So I'm not going to talk too much around late registration penalties, but you just need to know they are applicable in some cases and in some countries. Now, the late filing penalties. This is something that you really need to be aware of, because you may only file 1 day late, but if you file 1 day late, then potentially you could receive a full penalty in some countries. And this is where it's really key. So it's important to obviously file compliantly, but it's also important to file those returns on time. Because in some instances, in countries like France, it's a 10% penalty. So if you miss it by 1 day, you've got to pay 10% of the VAT payable in that country, which is incredibly steep for missing a return by 1 day. So this is where it's key. So it's key to understand the penalties in each country, because if it's a more relaxed one, then you can understand. Then you might not mind missing a day. But if it's one where it's going to cost you a lot of money, then you've got a lot of VAT payable in that country, it might be one that you look to make sure you definitely get there on time, even if you have transactions that you may need to put in the following month. But the penalties can vary in these different returns, so they may be fixed. They may be fixed varying. When I say fixed varying, I mean they have a fixed penalty, but it varies. The more times the more you offend, the higher your penalty gets. And these are these can be per return as well. So it might be you get fined on your late filing of the VAT return and fined on the late filing of the EC sales list. So it's not just the VAT returns; it can be additional returns as well. So it's key to file those returns on time. Late payment and interest. So late payments, it's pretty clear. The most important thing you need to understand is it's often when the payment is received by the tax office, not when you pay that amount. So if the deadline's on the 20th and you pay on the 20th, that doesn't necessarily mean that it will be perceived as on time. So this is where you need to be key. You need to understand your banking arrangements and you need to understand what the tax office's arrangements are. So we would always recommend paying in advance of a deadline just to make sure the tax office receives this on time. Because the one thing you don't want to do is it be received one day late and then again have a very steep penalty that to have to pay just because the payment's one day late. And again, the interests. Different countries treat interest in different ways. Some have a set amount. Some have cumulative. So all you need to do is understand the conditions. But late payments are very common. It's one of the most common we see, and it is around people not understanding the payment system that they use. They might allow themselves 2 days and then it takes longer. So always good to file your returns and make your payments as early as possible. I just wanted to point out a few countries like Spain. It could be incredibly difficult if you haven't filed your returns and then you register and you need to file returns that are over 12 months old. You can potentially have 25% in penalties, and that's if you voluntarily declare the VAT. So it can be really, really key to your business succeeding by not having these penalties and having these penalties and receiving these penalties in each country. So it can really, really affect the business. So it's one of the things we say is the most important. It's one of the most important. And the other thing as well is around the extra work that a late payment has. If you use an agent and you make a late payment, they have to do extra work, which then they potentially might charge you for because they're having to liaise with the tax office, trying to understand. If you make a payment to the wrong account, again, they have to try and sort that out. So all these things can cause you extra fees as well. So it's not just fees from the tax office; it's potentially fees from your agents. But yeah, it's one of these really, really key things. So one thing I did want to point out is the last point on the slide here is that voluntarily declaring stuff is always more beneficial from a penalty point of view than getting caught by the tax offices. The tax offices can give you the higher side of the penalty, which sometimes might be 5-10 times what would have been if you had voluntarily declared. And in some countries, there's some real big things that they can do. Like they can hold prison sentences in some countries if you are known to or if you've performed VAT fraud in the country. So it is really, really good to understand. You need to understand that these penalties are really, really important. It's not just a case of you receive a penalty and you pay it. They can get bigger and bigger and bigger, and they can hold more kind of bigger consequences than you might think. So it's just clear to understand the legislation and good from that point of view. Okay, so that's been the final part of VAT for Dummies. Again, my name is Matthew Harrison, Sales Delivery Consultant here at Avalara. My email address is there, so if you do have any queries or you need to register or you're looking to understand the tax requirements in a country maybe in a little bit more detail, then obviously feel free to get in touch. And I look forward to hearing from you.